Good morning, everybody. It's good to have you back here once again. After a very productive day one, I hope you're looking forward to another exciting day here at Istanbul Development Dialogues. A couple of reminders before we get started. We'd love to hear from you, so if you have any questions or comments, do send them our way by using the hashtag IDD 2019. And if you're wondering about guests, sessions, or all the up-to-the-minute information, you can do so by logging onto our website, idd.org.tr. That being said, one important announcement. Now, Istanbul Development Dialogues, or IDD, is all about dialogue between the UNDP and its partners. And the high mark, or a high point of this event, generally every year, is the Partners Forum. So if you're a representative of a partner organization or an individual that has something to say about financing sustainable development and you haven't had the chance to do so, don't worry, we haven't forgotten about you. You'll get the chance a little bit later on today. The Partners Forum will be held on Tuesday afternoon, this afternoon, and anybody who wishes to speak should definitely get in touch with Mr. Ben Slay. Ben, unfortunately, isn't here right now, but he sits next to me, usually up here in the front row. So get in touch with Ben Slay if you want to take part in the Partners Forum. That being said, let's get started. Our first event of the day is the Keynote Dialogue. It's on risk, impact, and accountability in sustainable development goals. It'll be moderated by UNDP team leader George Puma. George?
Thank you. Thanks very much, Alijan. Good morning, everyone. It's nice to be here with you on this second day. I want to hopefully follow on from where we left off yesterday with a very inspiring closing from Sean, who really put things into perspective, but also brought some energy into the room. It was also a little bit of a challenging topic that he addressed in terms of the timeframes we have to address this global challenge. So this morning we're going to talk a little bit about some of the impact, risk and accountability issues that we face in trying to unlock this potential finance that we talk about in financing SDGs. To help me with this, I have two panelists, and I'd like to invite Mr. Jobst Nieuws to join me up here, please. Jobst is the Chief Risk Officer for the European Investment Fund, and also Mr. Paul Horrocks. Paul, if you could join us up here, please. Paul is the Chief of the Private Finance for Sustainable Development at the OECD. So we have some bar stools to sit on, so please. Okay, the idea was to have a little bit of an interactive dialogue this morning. I think from yesterday's discussions, there's been a lot of talk about transformation. There's been a lot of talk about addressing SDGs. There's been a lot of talk about this $2.5 trillion we need, and we heard Achim Steiner talk about the transformation that's undergoing, but we didn't hear much about what that transformation is. And so I think today, to kind of get the discussion going a little bit, we need to kind of identify what some of the major changes are needed to actually address the challenges that we're facing at the moment. It's almost that we need to have our economies address a lot of these challenges. They need to transform in many ways. So I think when you look at a lot of the literature around this, there's many ways that it's framed, but I've come up with four to kind of get the discussion going this morning. The first issue is the need for substantial advances in human capital, both in education and health services, to help meet the growing divide in inequalities. The second one is transforming our economies to patterns of sustainable production and consumption, but also putting on a very rapid decarbonising trajectory. The fourth one is that we are now more urbanised than we ever were in the past, and so sustainable cities, smart cities infrastructure and high connectivity are really key issues that need attention. And the final one is harnessing technology and innovation for sustainable development along with the private capital to drive these changes. You may have some others that you may want to bring up later, but these are four that I've kind of come up to help frame this discussion of how we can perhaps unlock finance towards these particular issues. But yesterday we also discussed a lot about the challenges of the public policy lags that we have in trying to define these transformative effects. And we talk a lot about the role of private sector as being able to fill some of these development gains. But yet, perhaps from the perspective of the private sector, it perhaps raises more issues around in terms of the risk, the impact, the rate of return without these proper incentives in place. So Jobst, firstly, I wanted to turn to you. The role of development finance institutions is seen increasingly as a potential to support sustainable development going forward. As Chief Risk Officer in EIF, what do you see as some of the main challenges of putting this capital to work, and what do you see as investors may consider as issues? Are they really interested in having some of these public policy outcomes that we've been talking about? Thank you.
First of all, let me thank you for this invitation. It's a great honor that I can be here, and with all my humbleness, I will try to answer your question. But I would like to go a bit further. I mean, for me, the first thing, I just want to throw 2 or 3 things into the audience and then see how the reaction is. If you want to have the private sector coming into joining a public mission, I think the first thing we have to do is stop grants. That's a bit radical. But change grants into financial instruments. We have lived that with the Commission some 15 years ago. It took quite some time. But increasingly, the financing of the European Commission changes from grants into financial instruments. Why? Financial instruments are marketable. The market understands what that is. The market understands something that is priced. Those speak the language of the market. The second is a change of culture. I mean, there is messages to be conveyed. There's a narrative to be conveyed to the financial sector, to the private sector, to the private market. And the private market in our systems thinks on profit, return. What is in for me? Now, we have heard yesterday a lot of dangers, a lot of threats. I have been last week in another event where ethics was involved and so on. The market reacts not sufficiently on these threats or things of the kind because the market needs to understand a long-term yield which is linked to the SDGs. This is a change in culture. This is a change in communication. This is a change in education of market players. Another thing which we have heard yesterday is regulation. I think regulation is a reactive tool on something which happens in the markets, in society, and regulation comes always too late. I think it would be time to change from regulation to standards. It would be time to have standards like the SDGs as benchmarks for investment. So that is a bit what I just want to put into the discussion. And let's say this is the flip side of the coin of your question. Because not succeeding in these elements, in these key elements, is for me the biggest risk if you want to put the SDGs with the help of the privates on the road. You will not convince private investors to join grants, for example. It will not work. Grants have their role, but they cannot be the core of a financing where you want to have the private sector in. And so what we have done is, and there I stay, what we have tried, or we are trying now in my institution, we are trying to develop a methodology which arrives at a scoring of a non-financial return, a policy return, to be able to assess ex ante and monitor ex post the impact the policy return an investment has. Any investment has an impact. And the question is, what is if I want to know how it contributes to SDG, for example, how intensive is this impact measured at the 17 SDGs? That's in a nutshell what we try to achieve.
Okay, thank you. I mean, it begs the question is that not only do investors need to change the way they operate, the development industry needs to change the way it operates as well. We need to change our operational mandate as well. So, Paul, turning to you, the OECD is increasingly identifying the importance of private sector engagement in achieving the SDGs. Development partners, including philanthropy, they're opening new windows to engage in these issues. And we've seen a lot of movement, and obviously there's a lot of interest to see if this can develop further. But can you give us some examples of where you've seen the private sector beginning to move in this regard, and what kinds of avenues are they exploring, and do you see interest in them really kind of grappling with this impact of the investment and the opportunities to drive both development outcomes, policy outcomes, and private sector outcomes at the same time?
Yeah, thanks, George, and thanks again for the invitation to be here. Great to see that UNDP is leading this. I mean, I think from our perspective, the way we're seeing the market a bit is that the private sector has been quite active, particularly the philanthropy. And then now in developed countries, now we're seeing it move to developing countries, and DFIs and OECD are becoming increasingly more involved. So we're seeing that sort of move to developing actors. First off, we're seeing financing coming together, ensuring finance is going to where it is needed most, ensuring policy is coming together in terms of ex-post assessment. But we're sort of seeing where we're seeing the private sector really playing a role is innovation, catalyzing innovation, developing an ecosystem that promotes innovation, recognizing the role of the public sector in scaling pilots. And that's where the private sector can scale up. So it's up to us to demonstrate and for the private sector to come in and bring it up to fruition on scale. We're also seeing data. If you can't measure it, you can't manage it. So we need to facilitate more transparency, standardization, interoperable data. But you need funding for this. So we also need to be in the game and fund it and help drive it. The private sector can come in, but you need those evidence bases, you need those projects to come to fruition. We're starting to see some. I mean, we've got, for example, patient capital in K-Bash is an example that we looked at in Bangladesh, facilitating payments to rural communities, where we see something like 65% have mobile phones, but only less than 15% of Bangladeshis have access to formal banking. Now that's a way to sort of create innovation by allowing access to banking facilities for people in the rural environment. The other example that we've looked at is Root Capital. It's a not-for-profit social fund that advances prosperity in rural disadvantages environment places in Africa. So we can see those transitions of developing countries where you need innovation. So for example, in terms of the banking example in Bangladesh, but also you still need it in those fundamental areas of the SDGs like agriculture. So it's using both the innovation that we have in developed social impacting investing examples and transferring it to developing countries, but not forgetting those core areas such as agriculture, water, and all the other SDGs. So we're seeing a nice mix, but it's a bit up to us in terms of actors to bring in the private sector. We have heard a lot from organizations like BlackRock, JP Morgan, about the social consciousness and the need to mobilize. But we need to think a bit about the impact, because it is development money. It is up to us in terms of the multilateral system and the scrutiny that we have on us by parliamentarians, by actors, to demonstrate that impact. And I think we need to work with the private sector to get beyond jobs and start thinking much more concretely about the sort of metrics and the way we want to think about that.
Okay, so if we think about these big funds, the BlackRocks, et cetera, the pension funds and things like that, I was reading an article in the paper this morning. It was talking about if you were part of a pension fund, you put your money in the pension fund and you know, hopefully by the time you retire, there's enough there to retire, right? But if you knew that as you were contributing to that pension fund, that that money was going into unsustainable activities or activities that was undermining the global, you know, situation, as we heard yesterday from Sean in the closing, you know, with the challenges now, you know, would you still be putting that money in the pension fund? And obviously this comes back down to the issue of measuring impact, as you've both said. You know, but the question is can this impact measurement lead to the financing coming into meeting these multiple objectives and having this transformational effect? And it's not something that as different stakeholders or different people from different organisations that we'd immediately connect to financing, that, you know, we need to measure the impact either at a kind of ex post or ex ante or beforehand. But I wanted to ask you in terms of the metrics that we have, Paul, what has the OECD been doing on this issue in terms of trying to improve the measurement of impact on these financial, private sector financing and these financing opportunities that we have? It seems a lot is around innovation at the moment, but increasingly we need to move it more mainstream, would be the question.
Yeah, so I mean there is a lot of work that's being done. I will say that it's not been completed yet. And it's up to forums like this with the UNDP. We're working with you on looking at impact. We're working on the impact management project, which is trying to think a bit about impact in an accounting framework. So that's an ongoing, and that brings in the private sector and lots of other actors. It's looking at basically the practices, so generally accepted practices, and assessing those in terms of implementation. And thinking about what investors have in terms of processes. I mean, there have been examples like the RISE fund that was driven by the private sector, but we want to bring those in. We also want to think about the performance, so that's where the OECD is working, is generally looking at a conceptual framework for impact accounting that will be endorsed by governments globally, and then using that framework to measure and disclose impact using universally thematic and bespoke data standards. Then we'll contextualize the data based on targets, local SDG priorities to determine the impact on the global goals. So this will be used in terms of benchmarking, rating to score performance in relation to SDG targets, and using the valuation techniques to estimate the value of impacts expressed in a quantitative manner. This is an ongoing piece of work. We need to, I think, move on with this because soon we're going to be hitting a decade for the 2030 SDG target. So, yeah, I mean, we hope to see this come about in the next year or two. We're also working on a collective priority fund at the OECD, which is bringing together all the other actors across the OECD. So I work for the Development Cooperation Directorate, but the Financial Affairs Directorate, the Environment Directorate, the Statistics Directorate are coming together to look at what we can do in terms of building a framework. But we have to be coordinated. If we really stay in silo and go off and try and think up new things and develop new approaches that's not done in a coordinated manner, I mean, speaking to Jos, I mean, the idea is to have sort of standards, benchmarks. That's going to be the way that we can change the game and really drive this and get those impacts that we want to start seeing.
Do you think these big finance pension funds, they'd be interested to take up these standards?
I think so. I mean, they've got fiduciary duty to their members, but we've seen a lot of shifting in our conversations at the OECD with major asset owners. So the conversation's been mainly in Nordic and now starting to increasingly see the North American pension funds being interested in this. I mean, the opportunities for the future are going to be in developing countries where the SDG gap is the highest. So those pension funds, including sovereign wealth funds like the Norwegian ones, are going to have to start looking at the SDGs. A lot of actors that we speak to, like the Rockefeller, like the Gates, like Oxfam, they have humongous endowments. They would love to benchmark those investments according to the SDGs and think a bit about the impact more. So we're starting to see a shift. I mean, Africa is mainly a private equity play. So they are also talking about getting private equity into pension funds, because it's much easier to track your dollar if you're using a PE and investing in projects around that in terms of measuring the impact than if you're much further away in terms of a sort of index fund or something like that that's tracking for your pension returns.
Okay. Jops, the EIF, bringing the story a little closer to home maybe in the Western Balkans, the EIF has developed the Enterprise Development Innovation Facility to help countries of the Western Balkans. The financing mechanisms and the instruments that you've been talking about, you've developed to help support changes at the firm level, to help bring SMEs, financing for SMEs, to help them develop, to achieve some of these effects that you've been talking about in terms of growing business level opportunities in the Western Balkans. But increasingly, we've been discussing with you the idea of also addressing social issues in the Western Balkans as well, and the Youth Guarantee Scheme is one particular facility that you've developed. And you talked a little bit about the impact measurement, and do you think it's possible to have this ex-ante impact measurement which helps investment move to this upstream kind of dialogue a little bit more and would help some of these instruments that you've been working on?
I definitely do. I mean, let's say our impact policy return measurement methodology is still work in progress. So far, we have a fairly standardized assessment of the added value, the additionality of transactions, of mandates. But indeed, what we do, before we accept mandates, we look. Well, we have market gap analysis. We look whether the offer in a mandate is adequate to where we then should deploy the mandate, and we then check each and every transaction against the mandate. We also monitor eligibility, for example, under the eligibility criteria of the mandate. We monitor that during the life of the mandate. And so there are some things, and what is relatively new is also that we now have a IT tool-based process of allocating the different funding sources we have. I mean, we manage now about 140, 100 plus mandates, so smaller, bigger, and whatever. So we have a tool where we have a process which is basis of a process to allocate these different funding sources according to their investment policy for a transaction, so that we can justify why we took mandate X and not mandate Y. But we have to go further, and that is what I said before already. I mean, ideally, I would like to go further, let's say, to really be able to say, okay, a transaction X has, let's say, a pure return objective, which has its value for us because we are an IFI which has a return objective. We have to present return on equity. Another transaction has ticks 2 or 3 or 4 SDGs, or let's say that is the investment promise when we invest. And then you have to monitor this. That is why I want to come to some sort of scoring. And that is, again, and I come back to that, why we need standards. Now, coming to the OECD, I just want to mention it because yesterday there was also an allusion to this. I mean, first of all, everything is interlinked. I mean, we were talking about SDGs. Yes, that's fine. But, I mean, you have SDGs, you have reputation risk, you have tax, you have all sorts of soft targets, soft objectives, which now become very important and very accepted also in the market. And the OECD is an example with the action plan for tax avoidance. It has created a dynamic which was felt before in the market. The scientists did not accept anymore what 10 years before was considered extremely clever. And when the OECD took that up, it created an enormous dynamic, and we felt it. I mean, we are investing in private equity structures. So we felt this, and we are confronted now with the Commission driving this even further. Commission is shareholder in the EAF. Commission sits in our board. I can tell you the compliance officer has a hard life in the board, justifying each and every transaction in detailed analysis of the tax-relevant cash flows within a transaction. So this is an example how you can dynamize these policy objectives. And I think it is something that will, within the near future, happen also to all the elements which the SDGs want to address. Now, the SDGs are the international standard. You can criticize whatever you want with the standard, but this is the international standard managed and interpreted and lived by one internationally recognized organization. I think this is a huge opportunity to try to convey this to the market. But as I said before, the message must be right. And I mean, this is something which, this message is something we could then, as the community of the IFIs and MDB, could indeed put the SDGs on the road. Another thing what could be useful then from the UNDP side would be the certification of the methodology. Say, okay, you measure this in this and that way, and everybody has perhaps slightly different ideas about how to measure, how, with what methodology to address the SDGs in the daily business. But if we could get an answer from the UNDP to say, okay, the way you do it is fine and combines with what we have in mind with the SDGs, then we enter into a mutual dialogue and in a mutual cooperation to make this living. And that's what I mean with standards. That's where the standards can work.
Thanks. We have about 5 minutes, but I just wanted to ask you, if we move to this more instrument-based approach of delivering development finance with a lot of accountability frameworks, measurement frameworks. Firstly, do you think that there's within your own organisations, well, particularly EIF, is there an interest to really identify what the non-financial returns are? What are what you mentioned before as the the impacts of not just financial returns, but the impacts on things that you can't tangibly feel as such, right? So, but the policy issues. So this suggests that there's a lot of challenges around getting acceptance in the marketplace. Have you seen any shifts in this attitude towards this type of interest at all?
Yes, I mean it is an uphill battle within the organization and within the market. That is normal. But, I mean, one thing is clear. If you look at the upcoming regulations for the new EU budgetary program to 2021-2027, Invest EU, it's everywhere. Yeah? Whether it's called ESG or whether it's called SDG, the topic is basically the same. That's one point. The other point is, I mean, we are establishing now a fund structure which should allow us to cooperate even stronger with the private market, specifically on the equity side, and to fundraise for this structure in the private market, pension funds typically, or I mean, also, I mean, interested private family offices, whatever you want. And the request to have a framework for non-financial return, ESG typically, the request to have these standards is very strong, is very active. And we are getting our things together right now because we have investment sector restrictions, no arms, no tobacco, no gambling. And we have all these things somewhere. We have the tax assessment. But they expect a comprehensive framework how we address these things, and that's what we're working on.
Paul, in the development finance world, I mean, obviously blending finance, and if we move to this more instrument-based approach as a way of mixing different financing sources, I can see a lot of challenges with the governance structures and how do we keep everybody's accountability and how do we keep everybody happy. What's the OECD kind of done on this in this area?
Yeah, I mean, I think we're following up a lot on blended finance because you've got the impact, but then you've got the blending that mobilizes the big volumes of money because we're always talking about the gap. And we want to deliver the SDGs, but at the same time, we recognize that there's a massive gap. So there's a bit of an inter-push between the gap and the mobilization and the impact. So we at the OECD, we're very cognizant of the scale of blended finance, how it's growing. I mean, we're getting phone calls regularly from our members, from DAC donors saying, we want to set up a DFI. How do we do that? What do we need to think about? What are the risks? How do we think a bit about our institution in terms of the risk returns that we're willing to take and the development goal that we've got to deliver with our balance sheet and for our members? So there's a bit of a sort of tension around those, and sometimes you see funds being set up. We've heard that there's a lot of funds being created. It's a way to sort of outsource. Go and do solar investment for me for 5 years in East Africa. And deliver that as your mandate. So we're seeing a bit of proliferation. From our perspective, we want to make sure that there's transparency and transparency and transparency. Because without that, you're not going to be able to influence the market and that's the message that the private sector is also coming back to us. But there does need to be a bit of governance arrangements around these. So we're publishing a funds and facilities survey. We've got our 5 OECD DAC blended finance principles, which are first anchoring development when you're using a blended to anchor it to development. Secondly, to crowd in as opposed to crowd out. Then thirdly, sort of building markets. Fourthly, thinking in terms of your risk return, and fifthly, again, transparency around monitoring and evaluation. So those are and we're developing the guidance around those. So we're trying to sort of get good practices into actors, and so that we're all coordinated and acting in a coherent manner. But there is a lot of diffuse and different approaches. And I would say from our membership, so the DAC donors, they're on a little continuum. You've got some that are really at the far end and very innovative, very progressive, very much engaging the private sector, have really good frameworks, and then others that are sort of still catching up and learning. So it's about being able to help those at the back of the queue to jump forward and have those innovation leaps, both in terms of not innovation at the country level, so allowing them, as we've seen in the climate space, to sort of make those significant technology leaps, but also allowing the donors and actors and the private sector to make institutional balance sheet innovation leaps in how they engage on this.
Thanks. We've got to kind of take 5 minutes to see if there's any comments. I'm going to open it up now, and the opportunity, if the audience has any comments here, to either Paul or Jops, if there's anything they'd like to raise in this discussion. We'll take 5 minutes, and if anybody has anything to say, please raise your hand. So we've got one here and then one at the back there. So we'll take 2 to start with. It's a microphone. Thanks.
Good morning, and thank you for an enlightening session. This is Rabel from the Istanbul Center for Private Sector, the UNDP. And my question is to the gentleman at OECD. Talking about impact measurement, and it's great from the investor's point of view. We need standardization and accounting principles. But what are your thoughts from the point of view of the investees and the companies that then have to report on them? What are the efforts to build the capacity on that, and what sort of technical assistance will they need at this point? Thank you.
And we'll take 2 to start with.
Thank you. My name is Claudia Melle MacLeod. I'm with KPMG Norway. I have a question for Mr. Jobs Noyes, and it's about standards. You emphasized the importance of standards. One thing that I have found when talking to private equity firms in Norway, there's distaste for any kind of political involvement. So when we talk about governance in an ESG context, we're talking about fiduciary standards and board composition and so on. But when the UN talks about governance, we're talking about SDG 16, which is very much related to democratic governance. So do you see at some point the investment community moving towards the UN standard of democratic governance and prioritizing investments in countries that have strong human rights standards and the democratic governance institutions? Or will it always be a difference of perspective and investment will follow return on investment? Always. Thank you.
Okay, thank you for those two interesting questions. So, Paul, to you first.
Yeah, no, thanks for that question. I mean, really take the point. What we hear is also capacity, and technical capacity. So it's a crucial area, and us as sort of multilateral actors, donors, we need to make sure that the investee is prepared and well equipped to do that. I mean, we have seen, I think, a massive transformation, but there's still a lot of catch-up. So I think technical assistance can help that. And, you know, but it's also demonstration effect, and having the OECD and actors like the UNDP and others coming together in these joint initiatives and being really fully transparent about those accounting standards and seeing what that means. I mean, often if I'm you know, investing in a product, I sort of make the requirements in terms of what you report back to me. But I think we need to go beyond that and sort of collectively as a community say, well, this is the SDGs, these are the impacts, and this is what we're going to agree in terms of accounting framework.
Oops.
Yeah, thank you also for the question. This is a very difficult question, and I mean, honestly, I cannot answer it. But I'm optimistic. You mentioned the investment in democratic countries. Yeah. Whether I would go so far, I do not know. But things like gender, for example, this comes already. We see in the context which we have with the private sector an increasing relevance of the SDGs as a acceptable standard, yes. But whether the investment community really knows or is conscious about the long-term consequences, I don't know. Now, I'm optimistic because I think, as I said at the beginning, it is a cultural change which we need. Cultural change does not come overnight. And again, I take this example from the tax avoidance scheme. The EIF has a fairly strong position in the European private equity market. The moment when we started to say, perhaps we should not support any weird structure spinning from the BVIs over Panama to Luxembourg, we should create transparency of the cash flows, the tax-relevant cash flows. We should ensure that a structure in which we invest models the cash flow, structures the cash flows in the way that each tax authority which has the right to levy can use its means, can use its means to levy the taxes necessary. The moment we started to do that, there was a change in the market. And today, even today, a year ago or two, I spoke by chance with a lawyer who structures a lot of the private equity funds where we invest in. And he said, okay, maybe we know now what the EIF wants. And we don't discuss that anymore. So this is for me a fairly tangible example over the last 10 years, let's say 9-10 years, where there was a shift in the community which we are addressing. And I think the MDBs, the IFIs, have a crucial role to play, a role which they do not always accept, because they have the deep pockets. So they can have a catalytic effect in education. But you need certainty. Otherwise, you have no case for educating. And certainty, I come back, is standards.
Thank you. So we'll leave it there. Thank you very much. I think the key takeaways, and as we open the second session, is looking to ways that we change the way that we do business to also motivate a change in cultural opportunities to address the SDGs, that culture is within organisations, but it's not just about unlocking finance, it's unlocking the way that we operate. But this comes with many challenges, as we've just heard, around safeguards that need to be met. We need to be able to address key issues around human rights and ensure that there's transparency. Can impact measurement achieve that, help to achieve that, so there's a much greater flow of funds to some of these non-financial returns that we want it to work on. So I think that there's a lot of scope there for discussion today. We have some interesting panels coming up, but now I'd like to ask you to thank the panelists for their time, and so thank you very much.
Thank you.
Thank you. Thank you,